In this video, I'll be going through everything you need to know about investing in corporate bonds, how they work, when you should invest in them, and of course, how you can invest in them. But before that, do join my 9,000 members Telegram chat group to discuss or ask any questions that you may have. First up, what even is a bond? So let's explain using a simple analogy. When we need money to buy a big ticket item like a HDB flat or a car, where the certificate to own the car is as expensive as the HDB toilet, we will usually take a loan to help cover the payments. When it comes to bonds, the roles are reversed, where instead of us borrowing money from the banks are now borrowing money from us, which means when we invest in a bond, we become a legal loan, where we are lending our money to the company or the government. This money can then be used to pay for a range of business reasons, like paying off their debt obligations, purchasing new assets, fund their business operations, investing in new products, and so on. For example, in the recent Astra 8 bonds, the bonds were issued in order to diversify its funding sources as well as to achieve an optimal capital structure. Or in the case of Singapore Airlines, which issued bonds in 2020, it was to raise much needed capital to weather the financial storm caused by a dramatic drop in air travel. Then, in return for borrowing our money, the bond issuer will then give out periodic interest payments to us, or also known as the coupon payments, usually every 6 months. And when the bond finally matures, they will return our money back to us.
So simple.
But here's a question, why do companies and governments even want to borrow money from us? They don't have enough money to use meh? That's because it's typically cheaper to borrow money from bond investors as compared to the banks. Now, the way bond prices work is very similar to stocks, where when the company first issues the bond, aka a bond IPO, it has an initial pricing, or what's known as the face value. Then, once the bond is issued, just like stocks, the bond can then be traded on the open market, in which case the bond price may either go up or down, which in turn will affect its bond yield. For example, in this AIA bond that was issued back in 2023, the bond was issued at a price of $100 with a yield of 5.1%. So this means for every $100 you invest, you receive $5.10 in interest every year. Then, since the bond price has now gone up to $103, its effective yield has now come down as well.
But don't scared.
Because if you are planning to just hold the bond all the way to maturity, this fluctuation won't affect you, since you will get to receive your full amount or face value when the bond matures. However, while not all bonds are created equal, all of them follow one simple rule, and that is the higher the risk, the higher the reward. The first factor that will affect the risk is the issuer's credit rating, which can range anywhere from AAA all the way to C or D, which in the Asian's grading scale, C or D means can't eat dinner or don't come home. So obviously, if the company has a good credit rating, its risk will be lower, which means its bond yield would be lower as well. And conversely, if the company has a lousy credit rating, its bond yield would be higher. For example, DBS has a AA- credit rating, so its bond would have a yield of around 4%. On the other hand, a bond issued by Highflux, which has gone bankrupt a while ago, would have a CB high yield of 12%. While 12% sounds attractive, whether you can get back your money or not is another thing lah. The second thing that can affect the bond yield is the time to maturity, whereby bonds that have longer maturities will typically have higher yields as compared to bonds that have shorter maturities. That's because no one knows what might happen in the future, and with that uncertainty comes higher risk. Though, in some cases, shorter duration bonds can also give higher yields as compared to longer duration bonds. This is also known as the yield curve inversion, where during times of uncertainty, like right now, investors would demand higher compensation for their investments. Quick pause. If you are looking for the cheapest way to invest, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and so on. Their currency exchange rates are practically the same as the one you see on Google, and they offer tons of free analysis tools to help you with your investing journey. This is the best broker, and it's the one that I'm personally using. Sign up link down below to Interactive Brokers if you are interested. Alright, let's get back to the video. Now, there are many types of bonds, each with their own unique features. For example, plain vanilla bonds are your usual bonds, where they just pay regular interest and return your capital when they mature. Then, there's zero coupon bonds that pay no interest at all. Instead, they are issued at a discount and mature at face value. For example, if the bond has a 5% yield, you can just pay $95,000 to purchase this bond, and after 30 years, the bond issuer pays you back $100,000. Meanwhile, perpetual bonds don't have a maturity date, so in theory, they can go on forever. Though, in some cases, the bond issuer can choose to recall the bonds later on. Then, callable bonds are bonds which can be redeemed by the issuer prior to maturity. So then, when should you consider investing in bonds? Two scenarios. The first scenario is when you know you need to use the money in the short to mid term, like your child's education 10 years later, or a home down payment 3 years later. That's because by investing in a bond, you will know when you will get paid as well as when you will get your money back, assuming you are investing in a good bond, of course. This method of investing is way safer than investing your money into the stock market, which historically requires a holding period of at least 15 years or more in order to not see any negative returns. The second scenario is when you want to diversify your portfolio into safer asset classes. This is suitable especially for retirees who are planning to rely on their investments to fund their retirement, because you know it will be bad if during retirement the stock market crashes by 50% and they go, huh? In that case, bonds can be a great way to give you a reliable passive stream of income. However, if you are someone who doesn't need to use your money in the short to mid term, and if you aren't nearing your retirement, bonds are a terrible investment as they tend to give you very low returns when compared to the stock market over the long term. But then, here's a question. When should you choose bonds over money market funds? Again, it depends on when you need the money. If you need the money like next week, money market funds are a better choice, since you will get to redeem and get back your money within 1 to 3 business days. But if you need the money like 3 to 10 years later, bonds would be a better choice, since you get to lock in the high interest rates for a longer period. Now, let's say you are interested in investing in bonds. There are 3 ways you can invest in them. The first way is to subscribe to them on the primary market right before the bond goes IPO. This can be done via any of the 3 major local banks' ATMs, mobile banking, as well as internet banking websites. Otherwise, if you have missed the IPO phase, maybe because you were busy having fun or busy watching TV, the second way to get the bond is via the secondary markets. And since Singapore corporate bonds are traded on the SGX, you can just use any brokers that have access to the SGX bond market to buy your bonds, such as Mumu, Tiger Brokers, FSMOne, and Poems. Lastly, another way you can invest in corporate bonds is via bond ETFs. Right now, there are 2 very popular bond ETFs that you can check out. The first ETF is the Nikko AM SGD Investment Grade Corporate Bond ETF with the ticker symbol MBH. This ETF tracks high quality bonds issued by banks, government-linked companies, insurance companies, REITs, and so on. And it comes with an expense ratio of 0.26% and a 3.66% average yield to maturity. The second ETF is the ABF Singapore Bond Index Fund, which holds debt instruments issued by government across various Asian countries. In it, you will find your SGS bonds as well as bonds from various government-linked companies. This ETF has an expense ratio of 0.24% and a weighted average yield to maturity of 3.21%. And similar to how you would buy and trade stocks on various brokers, you can also find these bond ETFs in any of the brokers that have access to the Singapore market. So that was a quick summary of how corporate bonds work. Anyway, hope you found this video useful. Like, share, and subscribe, as I'll be posting new videos every Monday, Wednesday, and Friday.